Let's talk Turkey about Ireland's corporate tax rate. It's currently, and it has been now for almost 2 decades, 12.5%. That allows Ireland to attract a lot of multinational companies to come headquarter in Ireland and do their business from Ireland. Ireland takes in money from that. Ireland's been under huge pressure from the EU and other countries, especially America maybe, to increase its tax rate, to decrease its kind of level of attraction to these companies, to make sure that they get the cut of corporate tax profits rather than where the company is headquartered, i.e. Ireland. The class in Ireland has known about this has been beneficial for Ireland for a long time, and it's like a red line issue. It has been for 2 decades, and people such as Bertie Ahern talked about this, Brian Cowan, they were going to defend it. Brian Hayes of Fine Gael even said if the EU attempted to challenge Ireland's corporate tax regime, that he would be straight out the door. Well, I don't hear them saying it now. It seems to be that the word from Dublin is that they're going to capitulate and roll over to please the EU and please the OECD. This will mean increasing Ireland's corporate tax rate, decrease the amount of money that Ireland Inc. or the Irish state takes in corporate tax, and it will decrease the possibility of spending for public services, and also decrease the amount of money we have to pay off our very large public debt. There's another problem. Now, they're just talking about the tax rate, but I think an even bigger problem for Ireland is about the common consolidated corporate tax base, what they call the CCCTB. Now, they are the rules by which the corporate tax profits are divvied out to various countries in which the company is either resident or is headquartered, where its workers are employed, or where it sells its goods. Now, corporate tax base rules being introduced by the EU will mean that as we go forward, that the corporate tax profits will go to where the goods are sold rather than where the company is headquartered. That means it will be going to large countries like France and Germany rather than the small country where it's headquartered, such as Ireland. So irrespective of the tax rate, EU CCCTB means that Ireland going forward, when this is introduced, will have a lot less money, and you're talking 2 billion euro net per year less minimum. So Ireland is going to be financially and fiscally a very big loser with this move from the OECD, encouraged by the European Union, when the common consolidated corporate tax base is introduced, that Ireland will once again be the loser, have less money to spend on public services, will be squeezed. And also we have capitulated on the principle that the Irish government, those who we directly elect, are the only ones who can set the rate of direct taxation in Ireland. Let's learn 2 simple facts. 1, the EU is looking for ever closer union, less power for the nation state. The normal voter in Ireland will have less power because those powers are transferred upwards and outwards to unelected people in Brussels. And 2, the 12.5% rate was all a big lie anyway, because really these multinationals were never really paying 12.5%. They're always hiding behind this intellectual property rights, and that it really should always have been that if the companies were headquartered in Ireland, that they paid 12.5% of their corporate taxes to the Irish state. But sadly, that never happened. And we'll never know what it was like because, well, it's too late now. The government seems to have capitulated, and they love to tip their hat at the bully boys in Brussels. And that's been shown once again. And because the political class have capitulated to the EU, the Irish taxpayer, the ordinary Irish citizen, will be the loser. When are we going to learn? So my name is Hermann Kelly. I'm president of the Irish Freedom Party. Gora Magatsa.